Welcome to Clear Perspectives. I'm Mary Allmon, Partner and Portfolio Manager at Marietta Investment Partners. This is the second quarter of 2025 Economic and Financial Market Outlook. I'm filming here in our new offices at 833 East Michigan Street in downtown Milwaukee. The theme of this quarter? Uncertainty. Inflation is rising again, markets are correcting, and tariffs are shaking up global trade. Let's take a few minutes to break down what's going on and what it means for your portfolios and our outlook. The U.S. economy is sending mixed signals. Inflation surprised to the upside in the first quarter with core CPI at 3.1% year over year. Consumer sentiment is plummeting, down 27% from last year. And the Atlanta Fed is projecting a negative 2.8% GDP decline for Q1. But despite the gloom and the equity market volatility, there are some positive signs. Industrial production is holding up, housing is stabilizing, and the labor market remains very strong. This rising uncertainty for us, though, that means that the probability of the U.S. approaching a recession or recession-like conditions has risen meaningfully since our last outlook. The Fed is in a tough spot. Inflation is still too high for comfort, but growth is slowing. So the path forward is murky. What's next? A rate cut, a hike, a pause? Policy decisions will hinge on the next few months of data. The markets are reacting to all of this uncertainty and to the unknown impact of tariffs. Since February highs, the S&P 500 is in correction territory, which is a decline of 10% or more, and the tech-heavy NASDAQ is down more than 20%. These are meaningful declines. Amidst the volatility, investors are rotating out of growth and economy-sensitive sectors into defensive names like utilities, consumer staples, high-quality healthcare. I do think that there is still an opportunity in that analysts are forecasting an 11.5% corporate profit growth for the S&P 500. If companies are able to meet these expectations, that could be a catalyst for recovery and upside from here. But again, the outlook is mixed. If the earnings disappoint, couple that with weak economic data, escalating tariff policy, that could trigger more downside from these levels. Interestingly, international markets are showing some signs of life. European economies are stabilizing. Inflation has dropped below the ECB's 2% target, and monetary easing may be on the way. In China, some consumer-focused stimulus has been a net positive for Chinese equities. In the bond market, U.S. Treasury yields have dipped as these growth concerns have intensified. High-quality fixed income is still very attractive, and these yields, especially compared to the previous decade, are very attractive. I think a laddered strategy across short and intermediate term maturities is the best way for investors to participate. The second quarter begins with more questions than we have answers. I recommend investors stay diversified, be selective, and don't chase risk just because markets are moving. Opportunities will present themselves, and especially for longer-term investors, this is a time to stay focused and be disciplined. Thank you for watching. We'll be back throughout the quarter as updates unfold. And as always, I welcome your perspectives.